Hello, my name is Max, and I am part of the London-based client services team. Today we'll be discussing the topic of EU short selling rules. Just as a brief overview of the agenda, firstly, I will be discussing the history, background, and some general information about the EU SSR rules. Then, one of our lead compliance experts, Carl, will talk to you about SSR disclosure deadlines. My colleague Peter will then be taking you through specific rule code and how the SSR rules are reflected in Raptor. I'd like to just briefly say that we have limited the scope of this presentation to the areas that we believe affect our clients the most. There's a lot more to be said about SSR, and we could potentially be here for hours. So, let's begin. I'd like to start with a brief history of the SSR rules. It all began in 2008. As a result of the 2008 financial crisis, many countries began to implement varying bans and restrictions on short selling in an attempt to stabilize the market and keep prices from dropping. What was found is that, due to inconsistent regulation, it was possible to circumvent one jurisdiction by carrying out transactions in another. Additionally, a ban on short selling was found to limit liquidity and efficiency in the market without necessarily having its intended effect on price. Therefore, a coordinated short selling regime was required in order to permit shorting in prescribed ways. The EU SSR rules were then born in November 2012. So, what were the EU SSR rules trying to achieve? Firstly, as mentioned before, provide a unified short selling regime across Europe. Secondly, promote transparency in the market around short selling behavior. Thirdly, capture the outlook on the market. And lastly, to measure the economic effect of short selling without capturing the effect of shorting through hedging, which I will discuss in more detail later on when we go over netting. So let's take a look at what the EU SSR rules look like today. Let's start by discussing what securities are in scope for the rule. These securities include shares and financial instruments which are admitted to trading on an EEA market, EEA regulated market, or MTF, multilateral trading facility, subject to an exemption for shares whose principal trading venue is outside the EU. It is important to note that the EU SSR equity rule does not only capture shares, but also includes financial instruments with similar economic effects, such as futures, options, convertibles, etc. Similarly, there's also a separate reporting regime for short-selling sovereign debt and credit default swaps that my colleague Peter will discuss in more depth later. Next, let's discuss naked short selling. Naked short selling is banned across the board in all EU countries. What this means is that a short position must be covered in some way. The three options available to market participants when covering a short are shown on these slides here. The first and most obvious way to cover a short position is by actually borrowing and officially covering the short. The second is by having some contract or measure in place that dictates you have the right to borrow the security. And third and final way is called the locate rule, where the covered securities can be identified, and when asked, market participants must be able to show where or with what broker they were able to obtain the securities. The bottom line is a short position must be covered in some way. Next, let's discuss specific disclosure thresholds. The thresholds that were introduced are separated into public and private disclosures. Any net short position over 0.2% of issued share capital in a given issuer will require an initial private disclosure, which is followed by a disclosure at every subsequent 0.1%. An additional disclosure is also required when the position falls below 0.2% again. There's a similar setup for public disclosures, except the initial disclosure threshold is set up a little bit higher at 0.5% of issued share capital. Public and private disclosures are required simultaneously. Therefore, as an example, at 0.6%, both a private and public disclosure is required for the subsequent 0.1% change. As I'm sure all of you are aware, on the 16th of March, ESMA decided to reduce the initial private disclosure threshold from 0.2% to 0.1%. This change is set to last for the next 3 months, but potentially could last longer. These new thresholds are now reflected in our EU SSR rules and will be until ESMA announces a change. Okay, moving on to ESMA and the exempt list. Similar to the concept of home member state, the relevant competent authority, or RCA, identified for a given issuer is how the EU determines which jurisdiction that a given security must report to. Under EU SSR, reporting requirements for a given issuer are only relevant for one country, regardless of whether that security is listed in multiple jurisdictions. ESMA maintains a list of all securities traded on EU markets and which relevant competent authority is appropriate for that issuer. This is called the FIRDS list, Financial Instrument Reference Data System. This information can be found in the Reg Data section of FundApps as shown on the slide in front of you and is integrated into all our EU rules. Raptor will look up the relevant RCA based on the ISIN that you provided in your position file, and the relevant rule will trigger based on what is pulled from that data set. The next qualifier for a security to be reportable under the EU SSR is the EU short selling exempt list. This list is also maintained by ESMA and it counts for any security that is traded on the EEA market and therefore will be reportable under SSR, but has a primary trading venue outside of the Union, making it exempt from the SSR rules. We sometimes have clients query certain disclosure triggers under our SSR rules, especially when the issuer is non-EU. Usually this is a result of the FIRS list identifying the issuer to have a European RCA, but ESMA has not included this security on the exempt list, resulting in Raptor triggering a disclosure. I'd like to go over some examples of usual short selling scenarios, what we expect their outcome to be, and what to do if you come across them. Example 1 is pretty straightforward, and is what we would expect to happen for an EEA issuer. The issuer here is Tesco PLC, a UK security traded within the EU. The FIRS list identifies RCA to be GB, and the security is not included on the EU short selling exempt list. Given that it satisfies all other elements of the rule code, this falls into scope of the EU SSR GB equity rule. This is exactly in line with what we would expect to happen. Example 2 is what we would expect to happen for a non-EEA issuer. The issuer here is Nippon Shokubai, a Japanese security traded on the EEA market. FIRS identifies RCA to be GB. However, the security is present on the EU exempt list, meaning that no SSR disclosure is triggered in Raptor. This is also in line with our expectations. Example 3 is where things get tricky. This issuer is Jinko Solar Holdings Ltd, a non-EU security that is traded on the EEA market. FIRS identifies the RCA to be Germany, and the issuer is not listed on the EU exempt list, meaning that there is a trigger under the SSR Germany rule in Raptor. Because the ISIN is not on the EU exempt list, a disclosure is required under regulation. However, from our experience, BaFin, the German regulator, is likely to reject this disclosure. Let's talk about what to do if you find yourself facing example 3. As mentioned, we often have clients reporting their disclosure has been rejected in example 3. However, ASPR states that any security not present on the EU exempt list but is admitted to trading on the EEA market or MTF falls under the EU SSR reporting regime. Therefore, a disclosure is required in example 3 according to regulation. Additionally, as it is the responsibility of the regulator and the issuer to keep the exempt list up to date, we would recommend contacting the regulator and the issuer directly and ensure the exempt list is updated. The regulator can only legitimately reject the disclosure once the ISIN has been added to the EU exempt list. Now, moving away from FIRS, I'd like to briefly discuss netting for management entities. As mentioned briefly earlier, one of the purposes of the EU SSR rules is to identify the economic effect of short selling without capturing the effects of short selling by hedging. This is because hedging does not tell us anything about the investor's outlook on the market, as the intention is to mitigate risk rather than bet against a specific security. The way they capture this is by allowing market participants to net their short positions with the equivalent long positions in the same issuer. According to regulations, netting should be aggregated at strategy level, but because there is no clear definition of what that means, netting should be done at portfolio level, and this is regardless of corporate structure. What this looks like in Raptor is that our rule engine automatically nets long and short positions for a specific issuer at the portfolio level, then aggregates all the net short positions from portfolio level up to the top level entity. Short and long positions are netted in Raptor based on being in the same portfolio and having the same ISIN. What the slide in front of you shows is that only net short positions are aggregated. If the net position is positive and therefore long, this will not be included in the calculation. The number at the top is then the value that is compared to the SSR thresholds. The last topic I will be discussing is gold plating. While EU members must comply with the directive, they are allowed to build on top of the rules with their own set of regulations. This is called gold plating. Certain EU countries, such as the UK, Denmark, and the Netherlands, have chosen to do this. Let's take the Netherlands as an example. The Netherlands has an additional reporting requirement of the gross short position of an issuer on top of the net short position required by the standard EU SSR rules. The thresholds under this rule, however, are much larger, the initial threshold being 3% of issued share capital. Well, that's it from me. Now I'd like to introduce my colleague Carl, who will be talking to you about specific SSR disclosure deadlines. Thank you, Carl.
Thank you very much, Max. Hello, everyone. This is Carl from the content team here at Fundapps. For this segment of the webinar, I'd like to talk about the disclosure deadlines associated with the EU short selling regulation, outlining the way Raptor ensures that each disclosure alert generated shows when a filing is due, but also some of the practical challenges that compliance teams might face when ensuring that they're complying with this regulation. So first, let's take a look at what the regulation states is the time at which one must check or take a snapshot of one's positions, and then the deadline to file a net short position being disclosed. Article 9 of the regulation itself states that the relevant time for calculation of a net short position shall be midnight at the end of the trading day. Keep in mind that your position file delivered to Raptor is a snapshot at the end of every trading day. Further down in Article 9, the regulation notes that the disclosure shall be made no later than at 15:30 on the following trading day. Here it is clear that 3:30 p.m. is our deadline. Keep in mind that there are a few time zones in relation to the various EU jurisdictions, which means we have to adjust the deadline for a specific result dynamically based on the specific filing location. Of course, this is not something we will know until our disclosure results are calculated by Raptor. Looking at the last sentence from our excerpt, the regulation states, the time specified in this paragraph shall be calculated according to the time in the member state of the relevant competent authority to whom the relevant position must be notified. Here we discover that depending on where the RCA or the relevant competent authority is located for a specific issuer, we may have different deadline times. The deadline day and time is automatically calculated in Raptor using an adjustment based on the relevant competent authority for the rule associated with the disclosure results. Taking a look at the rule coding summary for the SSR equity rule for Finland, we can see that the deadline logic at the bottom of the screen is coded for 3:30 p.m. on the business day after trade date in relation to the time zone in Helsinki. This means that any short position disclosure alert to be filed with the FSA in Finland will be given the appropriate deadline automatically. For another SSR jurisdiction like France, for example, we will see that the SSR rule there is coded for 3:30 p.m. in the relevant time zone for Paris. If keeping track of time zones and disclosure deadlines makes your head spin, no need to worry. After your daily position file is run, Raptor will produce a disclosure result in relation to the specific RCA or relevant authority where it should be filed. But it will also reflect this time-specific deadline in an associated task in your dashboard. This task and the disclosure result itself displays a deadline which is automatically adjusted to the time zone where you are located. On the screen is an example of a result after our file ran against the SSR equity rule for Finland. Here we can see that our colleague Ebe, who has his location preferences set to London, can see this result showing it as due at 1:30 p.m. London time, adjusted 2 hours from the time zone in Helsinki. This means that for all tasks in your daily workflow, the filing deadline is clear. There's no fiddling around with time conversions or calculating which time zone the regulatory authority is in. Each user can set their specific time zone under the time localization box under the user preferences screen. Because the selection of time zones in Raptor is based on location, this also ensures that shifts in time due to daylight savings adjustments are also seamlessly integrated. I'd like to wrap up our focus on the SSR deadlines by considering where the compliance team who will be handling SSR filings may be located, so you are best equipped to meet the quick turnaround required. As we briefly mentioned before, there are 3 main time zones in Europe, which means that after midnight on a particular EU market trading day, the earliest deadlines will be in the Eastern European time zone, which is UTC plus 2 hours or plus 3 in the daylight savings period. For reference, some of the countries in the Eastern European time zone are Greece, Romania, Estonia, and our favorite example, Finland. I'd like to use Finland to illustrate the importance of managing where and when your compliance team actions disclosure alerts in this regime. Some of our United States-based Raptor users whose compliance staff is mainly or even solely based there have shared some of the challenges with these deadlines, for example. If your firm has compliance staff in Europe or the Asia Pacific region, this might be less problematic, but still important to keep in mind. As an example, let's consider that after a given trading day in Europe, My resulting positions led to a valid disclosure obligation, and my position was disclosable in Finland. If I was responsible for compliance monitoring, but a part of a team that only had offices in the US, let's say New York, and naturally my firm was also trading on the US markets, it's very unlikely that I would be able to send the file reflecting my end of day positions until the evening or late night hours in the United States. In some cases, the end of day position file might not be available until very early the next day, or what we call T+1. Let's take a look at when the short position disclosable in Finland is due on the day after trade date. In Finland, this would be due at 3:30 p.m., but when we perform the time adjustment, this means it's due by 8:30 a.m. New York time or Eastern Standard Time. We will either need to ensure our team covers an early shift or potentially expand our team to other time zones so we have enough time to file. If we're at a firm with a London-based compliance team, we'd have a lot more time to prepare and file our disclosure. We'd have until 1:30 p.m. Even better if we had a Hong Kong or Singapore-based team, for example, to help out, as they'd have the complete next trading day, assuming the position file was delivered on time. There are other ways Fund Apps may be able to assist your firm in this area by allowing you to send partial position files, but this topic is too far afield from our discussion today. If you are interested in that, our support team will be happy to discuss that matter with you another time. Lastly, I'd like to mention that in addition to these tight deadlines, filing methods can differ between EU jurisdictions and should be taken into account to ensure you have plenty of time to prepare if you are faced with an SSR disclosure. For example, in Finland, which as we mentioned has the earliest deadline given its time zone, one must ensure they have already registered for the regulator's encrypted email system before sending a disclosure. This means that if one is suddenly faced with their first SSR disclosure in Finland, one would have to scramble to ensure registration is complete and potentially miss the filing deadline. For any EU jurisdiction, the filing procedures are always outlined in the Instructions tab for the specific SSR rule in Raptor. I hope I've managed to shed some light on the topic of disclosure deadlines, and thank you very much for your attention. And now I'd like to introduce my colleague, Peter, who's going to give us further insight into the rule coding that supports the EU short selling regulation. Thanks very much.
Thank you very much, Carl, for those insights in regards to the filing deadlines. My name is Peter, and I am part of our New York City-based CS team. And I would also like to welcome all participants to our 6th installment of the webinar series. After we have already learned a lot about the historical and regulatory background of the EU short selling rules, as well as the filing deadline, we will now take a detailed look at how the regulations are actually translated into the Fund Apps rule code. Since we already touched a bit on the Scandinavian countries, specifically Finland, I decided to stick with this jurisdiction and use it as an example for the EU short selling rules. To give you a little bit of an overview, first we will take a look at the Fund Apps rule code for SSR Finland equities, focusing mainly on the determination of the relevant competent authority, the calculation of the disclosable position, and the thresholds. And in the second part of my presentation, we will have a quick look at the SSR Finland bonds rule as well. Also, again, if any questions come up, please feel free to post them using the chat function, and we will address them during our Q&A if time permits. Let's first get an overview of the rule details screen, and I will explain the different section in more detail in a second as well. In the upper part, we see the for each expression, which defines the instruments that are in scope for the short selling Finland rules. Next up is the value expression part of the rule code, where the calculation of a potentially disclosable short position happens. And towards the bottom, we display the disclosable thresholds, the different alert notifications, as well as the aggregation structures and the labels. Let's now have a more in-depth look at the first part, the for each expression. The first element of this expression is the union. This displays all asset classes that are considered in scope for the rule. Just as Max has explained a couple of minutes ago, our rule aligns with the AOSPHERE guidance and not only includes short positions created by trading shares, but also takes into consideration short positions created by the use of derivatives, such as options or futures, and we also look at index-related instruments, etc. As I'm sure most of you know, every element of this pseudocode that is highlighted in blue is actually clickable and allows to review additional information. If we take, for example, the first instrument, equities not WI, not everyone might immediately be familiar with this particular instrument, but by clicking on it, this will give us additional information. We can see now that the asset class equities not WI refers to equities that have been authorized and issued. Therefore, securities that have not yet been issued are excluded from the Finnish short selling rules. Subsequently, we have the where function, which is used to determine whether or not a position is actually disclosable. This is where the sometimes controversial calculation of the RCA, the relevant competent authority, comes into play. Just as Max has explained earlier, by running the ISIN against the FIRDS list, our rule code verifies if the issuer has the relevant competent authority of Finland in this case. If the FIRDS list has returned Finland as the RCA for a given security, the second step of our where filter is applied. Here, the rule engine verifies or falsifies if the ISIN of the instrument is currently included on the EU short selling exempt shares list. You can see this here. If the ISIN can be found on the list, the security is exempt from the short selling rule and falls outside of the scope of this regulation. However, if the ISIN cannot be found on this list, then this expression holds true and the rule code continues to be applied to this instrument. The penultimate step in this expression consists of the rule code making sure that the security is held normally. And what we mean by normal is that the security is not lent, borrowed, or taken as collateral. Last but not least, to conclude the for each expression, we have the group by function. This explains that the rule groups all instruments in scope according to the issuer ID. This has the effect that shares, for example, of share class A and shares of share class B would be grouped together as long as they both refer to the same issuer ID. Now, I would like to take a quick look at the middle part of the SSR Finland rule code. Here we can find the value expression and the thresholds. In the first line of the value expression, we see that this rule does not only group according to issuer ID, but also according to the portfolio name. And this grouping functionality represents our approach to the netting methodology outlined by ESMA, and Max has alluded to this earlier as well. If we look at the Aosphere memo on page 14, we can find that the net short position should be calculated for each individual fund and for each managed portfolio. Additionally, you can see this here in section 2, it is stated that a management entity should aggregate net short positions in an issuer for which the same investment strategy is pursued. In this context, ESMA defines an investment strategy as a strategy in respect of a particular issuer that aims to either have a net short or net long position. Since this definition is a little vague and open to interpretation, we determined to net short positions at the level that allows for the most granular view, which is the portfolio level. The next step in our value calculation is verifying if the sum of disclosable instruments of a given issuer is below 0. To do so, we sum up the quantity of the shares and add the equivalent shares the derivatives in scope are worth. For the SSR Finland rule, options, warrants, and covered convertibles are actually calculated on a delta adjusted basis. This numerator is then divided by the number of total shares outstanding, including the shares held in treasury. And you can see this here. And after all those calculations have been processed, the rule engine takes into account the applicable thresholds. And I'm sure you already saw, looking at the screenshot, those thresholds are from a time long, long gone. The older generation among us might remember those days, but since March 16th, we are actually working with a significantly stricter threshold of minus 0.1%. This brings us to the lower part of the rule code, where we find the alert levels, aggregation structures, and the rule labels. So looking at the first two alert levels, we see an information result and a warning. The info alert means that the result is above the minimum threshold, but hasn't crossed a threshold since the last disclosure. The warning means that the result is approaching a disclosure threshold, and it triggers when the result gets within a specific percentage range of that threshold. The default for those warning alerts are 10%, which means that, for example, if we have a disclosable short position at minus 0.09%, we would trigger this warning. While the previous notifications are more of an informational nature, the two disclosure notifications that you can see here, they require the user to take action. Just as we saw earlier, we currently have an initial threshold of minus 0.1%, which also triggers at every 0.1% movement, both in an upward and a downward direction. Additionally, there is a requirement to file a public disclosure at minus 0.5%. Last section gives us details on which aggregation structure the rules run on, which in the case of the SSR Finland rule is the SSR management structure. Usually, this aggregation is part of your management tree, meaning that the EU short-selling rules are applied to the portfolios for which you hold discretionary management power. The aggregation of the net short position takes place at the entity level, which you can see here. And this is where all the alerts that we just touched on would trigger. Labels and assignments, they do not necessarily play a central role in our day-to-day, but they would, for example, come into play if clients are in agreement with a regulator to disaggregate certain entities from their corporate structure. And now, to conclude this deep dive into the short-selling Finland rule, I would like to show you an example of all the things that we touched on before coming together in an almost magical way to trigger a disclosure alert in your environment. And this, I think, really showcases the strength of the FundLabs platform. So let's assume we have built a short position in a Finnish issuer, and we went below the initial minus 0.1% threshold. We would receive this disclosure trigger in the results screen. This already gives us some initial information around the disclosure, such as what entity it is triggering at and at what value. Clicking on this result, we are brought to the results details screen. Here we can find a lot of more granular information, which allows us to confidently disclose this position to the regulator. So once we have reviewed this trigger and verified that it warrants a disclosure, we can simply click on Generate and Disclose on the top left-hand side. And this will automatically generate a disclosure that not only pulls in the disclosable values, but it also uses the form properties that we have defined at the entity level. Once we have reviewed this form one last time, we send it over to the regulator and it's all happy days. Okay, I know this was already a lot to take in, but please allow me to briefly also touch on the EU short-selling rules for bonds at the end of my section. Generally speaking, the code's logic is very similar to SSR equities, and I used Finland again as a stand-in for the regulations that are being applied across the European Union. Now let's take a look at the rule code. Again, looking at the for each expression, we see all the instruments that are in scope. In the case of the short-selling rules for bonds, we include, of course, sovereign bonds themselves. We also include derivatives on indices, baskets, and ETFs that contain sovereign debt. And we also look at derivatives on sovereign bonds, such as futures and credit default swaps, and sovereign debt ETFs. Where a position has the issuer Finland, as you can see here, and is held normally, again, meaning not via lent, borrowed, or collateral instruments. Raptor will group those positions according to the issuer name, just like we saw earlier in the EU SSR equities rules. In the value expression, we calculate the percent of debt outstanding that we are holding. And this is actually another great example of how Raptor's automated processes support us in complying with disclosure requirements. If we look at the calculation behind the expression percent EU debt outstanding, we can see that there is a lookup function applied, and as long as we are exactly matching the issuer name, Raptor is able to look up the outstanding sovereign debt and use this value in the denominator. You see the lookup function here. And since ESMA publishes those values, the debt outstanding, we scrape it from the website, and then we automatically pull it into our calculation. And this ensures that we are always using the correct denominator when calculating short exposure to sovereign debt. As you can see here, in the case of Finland, we will find that the total debt outstanding is 656.7 billion currently. In the next part of the rule code, we see the alert and disclosure notifications. When we take a closer look at the disclosure thresholds, we realize that thresholds actually differ because they depend on the amount of sovereign debt that has been issued. This becomes clear when comparing the different countries on the ESMA website. Those thresholds are also automatically scraped, and as you can see here, in the case of Finland, the initial threshold is -0.5%, and subsequent triggers would fire at every 0.25% increase of the short position. And at the end, we see that the aggregation structure and the rule labels, again, very, very similar to what we have seen for the SSR EU equities rules. Okay, I know this was a bit of a tour de force through the SSR EU rules. And if you have any questions, please pop them in the chat, or feel free to send us an email later if any questions arise. I would like to address one question that was sent. Hi, to confirm if at the portfolio level we exceed an SSR limit, but at the entity level it's below the limit, do we still need to disclose? So the way it works is that we have to aggregate or roll up all net short positions from the portfolio level to the entity level. If your net shorts at a single portfolio are over the threshold, then your aggregated net short will also be over the threshold at the aggregated level. So because we net at the portfolio level, there is no scenario where you would be have crossed a disclosable threshold at the portfolio level, but not at the entity level above. I hope that answers.
That's right, question. Peter, because we take the net short at portfolio level and add them up then at the entity level.
Perfect. Thanks very much, Colin. For now, thanks very much for participating and have a great afternoon.